Hello, it's Jerry Romine and welcome back to my channel. If you look around YouTube, you see a lot of hype that the stock market is crashing or that now is the time to buy the dip. But more often than not, you have the blind leading the blind, and the problem is the leader thinks he has 20/20 vision. I don't want to see anyone jump off a cliff blindly, and hopefully you will find today's video very helpful. Nobody has a crystal ball for the stock market. I want to caution people from buying blindly. In today's video, I'm going to share my approach to buying stocks after 2 rough days where the market took massive losses. I'm definitely looking to buy the top stocks, but only if certain conditions are met. I'm not a financial advisor, and this video is for entertainment purposes only, so grab a cup of coffee and hang on, because this is not your normal stock channel. I'm still bullish on the markets because the president understands a strong stock market increases the odds of his re-election. Because of that, I expect the government will do everything they can to stimulate the economy and keep the stock market strong up until the election. Even if the market is kept artificially strong, we can still make real money in the market. But I'm a realist, and after 2 down days, the simple truth is we don't know what the market is going to do. To illustrate that point, let's look at the 2020 crash with a Webull chart of NASDAQ. Here we can see the crash, and it happened very fast and very swift, and I want you to count the days that we've got here. 1, 2, 3, 4, 5, and you can see we went down quite a bit very quickly, and this was the big drop. Then we've had the big rally, and now we've had 2 big down days. 1 day, 2 days. So after 2 down days, the question is, where is the market going to go? Nobody knows. And I really want you guys to remember this, because when the stock markets dropped here, everybody was saying the same thing: buy the dip. Do you buy it after this day, this day, this day, or do you wait for it to come back? And I'm going to show you how to wait for it to come back in just a little bit. Here's a mug from my merch store to remind us to buy the dips, and I want to emphasize that you want to take a long-term approach, and in today's market, be sure you really like the companies for the long term, because the markets might stay choppy for the next several months. Now let's go over the plan, and it's pretty simple. If the stocks continue to drop, let them fall until they come back over the 20-day simple moving average. There's no need to overcomplicate things, and in just a minute, I'm going to show you 10 stocks that I'm looking to purchase when the market comes back up. Just remember, what we don't want to do is to buy blindly. And if you didn't catch my recent video where I talked about how stocks are like homing pigeons to the 20-day simple moving average, be sure to check out that video. Welcome to Webull Charts, where we're going to do a little bit of technical analysis. Our first stock is Apple, and we've already got set up our 20, 50, and 200-day simple moving averages. The 20 is the blue, the 50 is the red, and the 200 is the gray. And hopefully you watched my recent video where I went over this in detail. The link's in the description if you have not. Because in that video, we talked about the 20-day simple moving average and how stocks are drawn to it like a homing pigeon is to going home. So here we can see that Apple has had a few very big down days. They closed right at the 20-day simple moving average, and if the stock continues to go down, we don't want to do anything. If the stock goes up and closes over that 20-day simple moving average, that would be a really good sign, and we would also want to watch the volume, because any movements on higher than usual volume are a confirmation of that movement. Now, one thing that we can do with Webull that's really cool is we can set an alert for this to happen. All we have to do is right click, and we're going to hit create an alert. I'm going to delete the price one because I don't want this one, but if I scroll down and click under strategy more, I can click surpass the 20-day simple moving average and hit the save button, and now I've created an alert that's going to let me know when that has happened. I am looking to buy Apple under the right circumstances. It's currently rated a moderate buy, and now we're going to look at the beast mode scorecard, and we can see the 52-week range is $52.77 to $137.98. The PE ratio is 35.4. The year-to-date stock gain is 66%. Their tattle ratio is 1.29. Revenue growth 5.7%. Operating margin an impressive 24.5%. Net income margin is 21.3%, and their levered free cash flow is 26.2%. If I can buy this stock on the dip where it's going back up, I'm definitely interested in this long term. Our next stock is Accenture, ticker ACN, and we can see they've been trading right along that 20-day simple moving average. They've had a couple of big days down. They tested it. They're just below it. And this is the same story as Apple, where I would set an alarm if it goes over that 20-day simple moving average and I like the company, then I would definitely look into buying this stock. We can also watch the volume as well. Accenture is currently rated a moderate buy. The beast mode scorecard shows the PE ratio is 30.3. Their year-to-date stock gain is 13%. Tattle ratio is 1.89. Revenue growth is 4.4%. Operating margin 14.7%. Net income margin 11.1%. And their levered free cash flow is 14.6%. Our next stock is Adobe, ticker ADBE, and we can see they've been on a tear. They moved away from that 20-day simple moving average by a large margin. I call this too much too fast, and it's very common for them to come back to home. And we can see they've had a couple of down days. They did go go down and they tested the lower range, and then they closed back up over the 20-day simple moving average. And on a candle chart, this is what's called a long tail. And if we come back and we look at another long tail that they had, we can see something similar where they traded on this day in a tight range, had a long tail, and they closed back higher. And what's very common after a day like this is they'll trade in a range close to that before they take off in another direction. So I would watch this stock and see what they do, and hopefully they continue to close over that 20-day simple moving average and then move on higher. Analysts have Adobe rated as a strong buy. Their PE ratio is 63.8. Their tattle ratio is 2.01. Revenue growth is nice at 19.3%. Operating margin is very, very strong at 31.4%. Net income margin 30.7%, and their levered free cash flow is 36.8%. So this is another stock that I'm really big on and I like, and I'm just looking for the right entry point to get into them. So hopefully the market goes up, and this would be another stock I'd be looking to buy. Our next stock is Amazon, ticker AMZN, and we can tell they've had a couple of bad days. They dropped down and they actually went below the 50-day simple moving average, which is bearish. But the good news is they closed back up closer to the high, and they closed just under the 20-day simple moving average. This would be a good one to put in an alert, where if they closed above that 20-day simple moving average, that would be a good signal to consider buying the stock. Amazon is currently rated a strong buy, and this could be a really good opportunity to buy on a dip as long as the market goes back up. The Beast Mode scorecard has a PE ratio of 125.2. Their year-to-date stock gain is 78%. The tattle ratio is 1.4. Revenue growth 27.7%. Operating margin 5.2%. Net income margin 4.1%, and their levered free cash flow is 8.4%. Our next stock is the ARK Innovation ETF, which is ticker ARKK, and this is one of my favorites. And if we look at the chart here, we can see they've had a phenomenal year, a beautiful run up. Every time they touch the 20-day simple moving average, they bounce off it and come higher. However, this time they've had a couple of bad days. They tested the 50-day simple moving average and they came back up. But what I really want to pay attention to here is the volume. They've had a lot of increasing volume, and this is much more than usual, and they're red days. So what I would want to see before I buy on this stock is I'd want it to close above that 20-day simple moving average, and I would want the volume to be higher than the normal volume. Based on 13 indicators, ARK is currently a buy. However, the current direction, it is currently weakening, which we just went over in the charts. That being said, their year-to-date stock gain is 74%, and I'm very bullish on this company as a whole. Our next stock is Zscaler, ticker ZS, and we've got some classic technical chart analysis here on these 20 and 50-day simple moving averages. Here we've got the 20-day simple moving average. It's cruising right along. It touches it, it bounces up, it consolidates, touches it, shoots up after earnings, consolidates, returns to the 20-day simple moving average, and the cycle repeats itself. And then right here at this point, it dropped a few days. It went below the 20-day simple moving average, which is a red flag, and it went down and touched and tested the 50-day simple moving average. From there, it bounced up, went through that 20-day simple moving average, which would have been a good time to buy, and then it continued to shoot up. Now we've had a couple of negative days, and the same thing happened. It went through that 20-day simple moving average. It did a perfect test on the 50-day simple moving average, and now if everything goes really well, it's going to return back up, and it would be a buy signal when it crosses over that 20-day simple moving average, and would also want to be watching the volume. Zscaler is currently rated a moderate buy. The Beast Mode scorecard shows the 52-week range is $35 to $163. The current price is $134.34, and the estimated intrinsic value is $168.61. Their PE ratio is negative 247.5, so that tells me it's a growth stock. And on growth stocks, I like to swing trade these, so I probably wouldn't own it a year, but I would still be looking to get in and out the same way that we've covered. And we can see that their net income margin is negative, which is common for a growth stock. Their levered free cash flow is 8.1%, so that's a really good sign. Our next stock is C Limited, ticker SE. We can look at the chart here and see the same trend, beautiful 20-day simple moving average. They've recently shot down below it. They closed right at it. So if they continue to close above that 20-day simple moving average, that would be a good sign for me and an entry point. Now let's talk about something else. Let's say that they continue to go down. If they close below the 50-day simple moving average, that would be a major red flag for me, and that would be the time to hit the panic mode. And the panic mode for me would be like, damn, it closed below the 50-day simple moving average line. Let's watch it and see what happens. Other things we'd be looking for on the chart would be what's called a moving average crossover, and that's where the blue line crosses below the red line. So if the blue line is below the red line, I would not be buying in this range. I would wait for it to cross back over the red line, and that's when I'd be looking to go long. And that's a little quick lesson on crossovers. C Limited is currently rated a strong buy. Their PE ratio is negative 60.3. Their current stock price is $144.15, and the analyst target mean price is 169.58, so that's got some nice upward mobility. Their tattle ratio is 1.16, and here's something I love on a growth stock, and that is revenue growth. Their last 12 months have a revenue growth of 133.9%. Booyah, ching ching. That's definitely something I like to look at. And the rest of the numbers are just okay. They're negative, they're a growth stock, it's common. Our next stock is Microsoft, ticker MSFT, and this is a stock that I would love to buy some on the dip. We can see exactly what's happened. They've dropped, had a massive red day here, and this is a very long candle. And then the next day, they had a big range, but they had a very long tail. And this tail is actually a bit of a bullish indicator because they tested very low, but they came back and closed high. That's a good sign, and I would hope that it closes above that 20-day simple moving average, and then I would be looking to get into that position. Microsoft is currently rated a strong buy. Their price right now is $214.25. The analyst target mean price is 232.36, so a little bit of upward mobility. Their PE ratio is 36.6. The year-to-date stock gain is 37%. Their tattle ratio is 1.65. Revenue growth is 13.6%. Operating margin is very high, which is a great thing at 37%. Net income margin and levered free cash flow are both very high at just over 31%. Our next stock is NVIDIA, ticker NVDA, and this is a stock I've made a lot of money on this year, and I went ahead and switched the chart to a 5-year weekly chart just to show how these moving averages work. If we would have bought back here, look at this, a beautiful, nice run up, and this is a great tool for long-term investors. And what you want to remember is we always want to be above the moving average lines. Once the stock market crashed and went down, we would have gotten out of the stock and stayed out of it, and then we would have gone back into it whenever the moving average crossed over, where we've got the 20-day crossing the 50-day simple moving average. And since then, it's had a nice run up. It did go down and test the 50-day once, to which it bounced back, and now we've had a massive run up. And now let's look at the year-to-date chart. With the year-to-date chart, we can see this massive run-up, and now it's simply returned back to the 20-day SMA. No need to panic, no need to get excited. Let's watch it and see where it goes, and as long as it stays above this 20-day simple moving average, we can get into that stock. If the stock continues to fall, that's a good sign for us to stay out and wait for calmer waters when it's safer. NVIDIA is currently rated a strong buy. The Beast Mode scorecard shows it's got a current price of $504.90, and the analyst target mean price is $541.37, so that's a little bit encouraging. The PE ratio is 91.9. Their year-to-date stock gain is very nice at 115%. Their tattle ratio is very nice at 2.24. Their revenue growth is also strong at 28.3%. Operating margin is nice, 28.6%. Net income margin is 25.9%. And their levered free cash flow, they are loaded at 38%. This is what good financials look like, and this is why I like going long on a company like NVIDIA. Our next stock is Tesla, ticker TSLA, and this is where I give the big warning. Beware. This is a volatile stock. This can be dangerous. You can lose money. So I just want to really stress that for Tesla. But if we look at the 20-day simple moving average, we can see much the same. It does follow the trend. It does return home. It has tested things. It shot up in a record fashion, and Tesla breaks a lot of the rules. And these are really big, long candlesticks. The longer the bar, the more volatility, and that's why this stock can be so dangerous. That being said, it had a massive ran up. It returned home to the 20-day simple moving average. It tested a lower amount, and it closed higher. So this is actually a bullish sign on Tesla. I'm going to be watching it, and I'm hoping to load up on more Tesla because I'm expecting a good big announcement come Battery Day. The analysts currently have Tesla rated as a hold. The PE ratio, they just turned positive last quarter for the first time, is 1,036. Their year-to-date stock gain is an insane 400%. The return over the last week is negative 6%. Their tattle ratio is respectable at 1.42. Their revenue growth is 3.1%. Their operating margin is 4.7%. Their net income margin is 1.4%. And their levered free cash flow is 3.1%. I just want to stress to be careful and don't blindly buy stocks. After 2 bad days, we don't know if the markets are going to bounce back strong or if we are 2 days into a crash like we had in March. Even though I'm still bullish, I wait for confirmation that the stocks are moving back up before I buy. I really hope that you guys enjoyed today's video, and always, if you don't mind smashing that thumbs up button, please do, because it helps the YouTube algorithm in a major way, which helps my video reach more people. Be sure to follow me on Instagram and check out my Patreon if you'd like to receive easy to understand fundamentals on stocks for just $20 per month. If you have any ideas for me, make sure you let me know in the comments down below, and if you haven't already received a free stock from Webull worth up to $1,600, use the link in the description. I really like their new Desktop 4.0 trading platform, and it's definitely worth checking out. Sending love your way, thanks so much for watching. Stay profitable, and I'll see you on the next video.